All right, March 11th, putting the market webinar in the books. Exciting times. Not any shortage of information to digest and put together here. One of the things we're going to promise you guys, we are not going to inundate you with too much information. We are not going to drill into every little devil that, is announced on CNBC. It's actually been a little bit of an information overload for me watching financial news these days. It seems like everyone wants to turn everything into, every molehill into a mountain. So we're going to try to stick to what's really, in our view, impacting the markets and kind of keep it digestible. And this way, because one of the, a great book is The Signal from the Noise. And it's understanding where the signals are that are moving the markets for and kind of filtering out that noise piece. And we're going to try to do our best on this webinar to help you guys with that and keep things focused where they need to be. And I know if we're watching five different news channels right now, it's a little hard to know what exactly is driving things and meaningful for the market. We are not a politics show. We are not here to talk about those issues, but we do want to help you filter through on what the markets are responding to. Anything you guys want to add to that, Luch or Brenda?
No, yeah, I think that's the key takeaway, especially as we go through some of these slides, is understanding, what news stories are or things out there that are affecting the economy or could or the market and kind of general versus what are just other stories out there that might make headline news for the day or might have different effects on kind of like worldviews but not necessarily from a market standpoint. So kind of parsing through all of that and understanding what are some of the driving factors versus, hey, here's just, headline news generally.
Yes, sir.
All
Let's
right,
dig
Brad.
in.
Yeah, so jumping into the, review of market vitals, looking at the major indice performances year to date, the S&P is down about 1.5% and NASDAQ down about 2.5%. These numbers are from last Friday.
Thank
Yep,
you.
I got. Yep. So if you kind of look at today, Monday there was a positive day, and Tuesday and today are kind of flat for the S&P and Nasdaq. And then if you look, kind of where if you look at last month our webinar to today, you saw the Russell and the Vanguard Total International Stock Index. Those two kind of leading the charge from a year-to-date perspective, but have since pulled back too. So that's really, if you're looking at it, like the performance from a year-to-date perspective, it's really been the last month that has been driving these numbers down, and a lot of that has had to do with, some of the news stories that have come out, like the, Iran conflict and things like that. I think something interesting on this page too to kind of point out is Bitcoin. Year-to-date down about 20%, but over the last month only down about 1.8%. So when you kind of look at that, that's similar to what the Nasdaq has done. But if you kind of look at that at face value, you might expect a little more, I guess, volatility from that aspect of it, just given, but also from that standpoint of it already being down a significant amount more this year. So that could be, one of the things to take in consideration too.
Yeah, it's pretty crazy how 1 month can kind of change everything. And just to give a little context, at the start of the year, and we've said this on some past webinars and in some past monthly commentaries for those that join us regularly or consume some of our content. We've kind of been musing that 2026 is likely to look a lot like 2025 from a market behavior standpoint. If we all recall from a year ago, I know a lot's happened in 12 months. The new administration came in immediately. It was fast and furious on new policies, fiscal policies, tariff policies, Doge, a number of things implemented very fast and in a very jarring way, almost intentionally. And 2026 at the start with Venezuela and now Iran. It seems that we're getting and the tariff policy, the Supreme Court ultimately ruling that the tariffs were not legal, and then implementing a new strategy of putting tariffs in All of this is kind of jarring to the market, and it's a lot for them to digest at once. And so this is likely to kind of, similar to 2025, the market ultimately kind of got used to it. And this also happened with the Russia's invasion of Ukraine. I mean, that war's still happening, but it's not talked about that much from a market perspective. It's still a humanitarian crisis, but it's not a market crisis. We kind of figured out how to, figure it all out. If it wasn't for the Strait of Hormuz right now, this probably wouldn't be as exciting for markets as, we've just went through a big, I mean, we're still going through a humanitarian crisis in Gaza. So you've still got these conflicts that are going on. It's a question of how disruptive they are, and that's really what's driving it. And that's kind of what led to we had a pretty good start to the year. We look at that right column for the major indexes, right? You got the year to date. We now see about half negative, half positive. If you look over at the 1 month performance, though, I mean that's where everything kind of happened and turned around. And that's even true on the sector performance to
Yeah.
some degree. Obviously, energy, when oil prices go up, people assume oil companies are going to make a lot more money. Um, and the industrial sector includes a lot of the defensive names, aerospace and defense names, which has been a very strong sector. So, the rest of it is kind of responding in a pretty normal way. Um, is it helpful to kind of talk a little bit about as oil prices go up, like what this kind of immediately, I'd almost say there's like a three-part natural reaction for industry veterans here. Conflict in the Middle East. Conflict in the Middle East equals oil prices go up. Oil prices go up equals interest rates less likely to be cut.
Yeah.
That's kind of like step one, step two, step three.
Yeah.
If I woke up in the morning, someone called me on the bat phone and said, "Hey, there's conflict in the Middle East," I'd be like, "What are oil prices doing?" And if the answer is oil prices are spiking up, like they are here in this chart that we have, and this is actually a 5 year chart, so that shows you the spike when Ukraine. If we look over in on the, I'll call it the leftish
Yeah.
half. That's Ukraine's invasion of the Russia's invasion of Ukraine. That's the impact of oil prices. Oil spiked up. We have a similar spike over here. As you can see, the war is still going on, but oil kind of receded back. The market figured out a way around it, figured out a way around the supply chain issues that happened with the invasion in Ukraine and the disruption in that region. It's probably a little bit tougher with the Iranian conflict because that strait is so essential to so much of what's being shipped. But so you will definitely have a period of time with higher prices. But as with everything, I'd actually, I'd bet on the market here, figuring out an alternative, even if we don't figure out a resolution to the conflict. So I don't think that this can, go as long, similar to what we ran into with the Ukrainian thing. You guys have anything to add to that? I know
Yeah.
this is an absolutely third rail topic to spend too much time talking about Iranian conflicts when it's only 10 days old. But Brando, you look like you're ready to jump in.
Yeah, no, I think just if you look at the chart and something like we talked about, if like last week coming in, like Wednesday, Thursday, Friday of, oil prices, like where are they? And I think, one of the things you mentioned, Jordan, while we were talking was, taking a look at the 5 year chart and, over those longer periods of time, it kind of looks more like a blimp in the radar versus like when you're actually in it. And then that's kind of taking over everyone's, news feeds and everything like that. So even in 2022, just looking at this, it was about 6 months before it went to 80 versus over that entire 5 year time frame, where it was you kind of saw it spike up to that high of 125, but then kind of heading into the summer, it went back down and kind of normalized over this remainder 4 years or 3 years since then.
Yeah, and there's a natural cyclicality to oil prices where it tends to go up in the summer. So, even though it kind of spiked on the impact of the conflict at the beginning of 2022, you can see it kind of recede back and then spike back up
Yeah.
once we get into the summer months as people are driving, and that just tends to be the heavy consumption time. And then it kind of started dropping again once you get to the winter, and we had a relatively warm winter that winter, so heating prices are lower, and there's some alternatives that people can use. But then, you'll see in 2023, it kind of spikes up again towards the end of May and June. And that's a natural cycle. Normally you want to be long oil going into the summer months if you're an oil trader. That would be the preferred position. So it's probably, I would imagine it could end up being somewhat similar to that 2022 experience. That's just going to make it really tough for the Federal Reserve to cut rates, and have conviction in that. We also have, oh, what a great
I
segue.
mean, yeah, the segues are on point. I'm trying to keep up.
I'm telling you, man, your slide change clicks are just on point. We got a new Federal Reserve Chairman, Kevin Warsh, coming in. I mean, he's not approved yet. He's got to be confirmed by Congress and anything else. I would be amazed if he is not confirmed. That would come as a huge shock. And honestly, I think as far as Fed picks, for head of the FOMC, I think he's a good pick. I think he's a good pick. I don't know. What do you guys think?
Yeah, I mean, I agree. I think we spent a lot of time last webinar talking about it too, even though he wasn't the official nominee at the time. But to your point, I think as we kind of look at what's to come this year, depending on how long this could last with Iran, if there is an inflationary aspect to it, if it lasts for an extended period of time, of how that kind of plays into his viewpoint as he comes in like later in the year, and then still with Jerome Powell in for the next couple months. But how does that transition and kind of come apart as they kind of view the world and what's to come with inflation? Is it just, oh, the numbers for that month were a little elevated and they'll come back down, or is it kind of an extended elevation because of everything that's going on?
Yeah, and we did just have a CPI report today. Came in line, about 2.4%, which is about, where it's been kind of hovering around. I'd say that's generally a good number, but that really doesn't include any of the oil shock from the Iranian conflict. That being said, normally when we talk about inflation, we talk about core inflation. Core inflation actually X's out food and energy prices. So if you're really a Fed chairman, like you kind of say, well, food and energy can be volatile. And so we don't, we look at a core number, which kind of X's that stuff out and it's a little bit more stable. So I think it gives room for the Fed both to say, well, this is, and I'll use a horrible word that no Fed chairman should ever use again. This could be transitory. But that also being said, it doesn't give them a lot of space because oil is such an input in so many other things that are included in core. The other challenge, I think, is interest rates are staying a little bit high. And, on the 10-year, so interest rates have kind of moved up a little bit. We were around 4% last month. We're now at about 4.2%. That's not a huge change, but that kind of tells you directionally that people are expecting a little bit higher inflation as a result of this. And I think that it's going to be tough for the Federal Reserve to kind of stay on track. We were expecting more cuts, and I think that those expectations have kind of come in, and that probably seems about right. Just to kind of put as a reminder, Kevin Warsh is known to be a little bit more hawkish. When I say hawkish, that means not so inclined to cut rates and support the market. That's his reputation. He was on the Federal Open Market Committee back in during the financial crisis. He has been critical of zero interest rate policy in past talks. He's felt that that kind of led to bubbles and kind of made a deranged incentive system. I forget exactly the language he used, but so it was very interesting to see him as Trump's pick because Trump has been so in favor of cutting interest rates. Very vocal about that. But I think people are feeling like Kevin would not have gotten the job if he didn't, have those sentiments of being in favor of cutting rates. So it's interesting. We kind of get a guy who's a history of being hawkish, but clearly if he's applying for this job, he's got to send a message that he supports the idea of rate cuts. And this conflict with Iran is just going to make it a little bit tougher for him to convince the other members of the committee to jump on board if he still feels that way, and the data, is ambiguous.
I think that's good. Oh,
No,
you
no,
want
you're
to
good. Sorry,
go
sorry.
back real quick, Brandon? Just so that everyone kind of knows what we're looking.
Oh, Brandon's first miss on slide switching.
That's on me. I'll take it. Just so we understand what we're looking at is the expectation for the next Fed meeting on March 18th is like 97%. That rates will remain unchanged. And to put things in perspective there, in 2025, we had three 25 basis point cuts. And the expectations as of now for this year is that we will have one 25 basis point cut. So again, as we gear up for that news to be released on the 18th, it's looking like the expectations are no changes.
Yeah, I think next week, if they cut interest rates next week, I will eat my hat. No barbecue sauce.
Great context, Jordan.
Yes. So on to the headline reviews. Obviously, the Iran conflict has been the forefront of everyone's news feed. I think one of the things to point out is just the initial market reaction too of how I guess 2 weeks ago now the market was kind of muted at first, and then last week was really kind of where we saw that volatility start to come in. And something else too that we thought was interesting and that should be pointed out is as you kind of look at different assets and how they did over the past week. So this is as of Friday again. So basically like Monday to Friday of last week. Generally you would have thought, gold being more of a safe haven for assets of, times of volatility that would have been up. But it was actually down about 3%. And some of the technology and software stocks were actually up, especially during, we talked about this in our last webinar of things like CRM where, fundamentally, we still like all the fundamental data from the company, but due to some of the business model changes and adjustments they're making there with AI, that kind of affected some of the outlook and sentiment towards them. But last week during all of this, CRM, Salesforce, Adobe, Microsoft were all up, while gold was down, and some of that also has to take into consideration if you look at gold just year to date up 18% versus just use Salesforce as an example down about 24%. So it's kind of an indication of where the buyers and sellers are of the market and kind of recognizing how well gold has done not even this year but also last year. And similarly on the opposite side of why is Microsoft down so much when the fundamentals, if you look at their revenue growth and profit margins, why is that down so much? Is it really just from a sentiment standpoint, or is it a company standpoint? And if you look at Microsoft's, you can clearly see that there's being more buyers there at this time and willing to jump back on that with it being down and recognizing that here's a pretty good opportunity.
Yeah, and that can also be a product of if I'm a hedge fund and I'm momentum chasing, I'm going to be long gold before this event of Iran, right?
Mm-hmm.
Like if everything's just kind of cruising along, I'm going to be long gold, short software. That's a pretty typical long short hedge fund that's trading on momentum, which means I'm buying the positive action, I'm shorting the negative action. And that's what a long short will do. They will, be sellers of what's going down and buyers of what's going up. And basically, you just try to avoid any macro event that's going to change the trend. Well, a unexpected war is going to potentially change trend, and what happens then is a risk manager comes over to a trader at a hedge fund's desk and says, "Take in your exposure." What taking your exposure means is get out of your positions, sell your longs, buy your shorts. And that might be what we saw a little bit more here. I don't know if large institutional buyers and sellers were reacting as quickly to this news. And again, if you think about it, think about each of the conflicts that have happened. So, the US and Israel attacked Iran last year. Market didn't even move. This was back in June. Market had no impact. Beginning of the year, the administration announces that I don't know if attacked Venezuela is the right word, but basically some form of military operation in Venezuela. Market didn't move. So I think that the market's kind of learned again, even the conflict in Gaza, market hasn't really had a huge response. So the market's kind of learned that these things aren't as impactful. So if you're an institutional trader, you're going to kind of sit on your hands and be like, well, let's see what happens from here. If you're a day trader, you're going to do whatever it is day traders do. And if you're, running a sophisticated trading strategy at a hedge fund, most likely your risk manager has told you to reduce your exposure. And that's a very normal outcome. So while this might seem a little weird, it actually kind of makes sense when you think about market dynamics. I also don't know if this conflict really has, other than the change in interest rates, much of an impact on some of these companies out here. Some of the names that we see in there, some of the Nasdaq names, even some of the companies in the US. If this war does not go on for a long time and we are able to use the Strait of Hormuz like pretty actively, then I don't think this is going to have a major it'll be a humanitarian crisis. It might be something we talk about a lot on political channels. I don't know how long the market's going to talk about this, similar to the conflict of, Russia and Ukraine is rarely talked about on CNBC or any of the business channels. Do we want to spend any more time on this, or I think we're.
Yeah, I mean, you had another great segue into this slide.
Great segue.
Woo!
So this is just a nice chart that we had found, kind of giving an overview of markets during war times. If we look at more recently, Russia invading Ukraine in 2022, that first week after the invasion had happened, the S&P gained about 3.3%. But after the 12 months after that invasion had started, the S&P was down over 6%. And as Jordan is saying, what's important to keep in mind here is kind of the overall economic backdrop in that scenario with surging inflation kind of being the writing on the wall. But if you look at some of these other examples in this chart, it just goes to the theme of it's important to break down if this is an economic issue, if this is a political issue, a humanitarian issue, and kind of what's going on more than just the headline in that first week.
Yeah, like even if you look at Russia invading Ukraine, there were also other factors going on at that time, like with rising interest rates and high inflation at that time. Even if you go back to 2001 when U.S. invades Afghanistan at the end of the 12 months with the market being down, there's also other outside factors in that, like 9/11 just happened. So it's not so much that this specific event happened. You kind of have to take a step back and take in everything that was going on at these different time frames and whether those had a positive or negative effect on the market. Not just that there was a conflict going on at that time. And, to Luch's point and Jordan that they brought up before of as the news comes in of kind of taking an emotional step back and looking at it logically of, I know I, believe in this one way or the other, and, this is a humanitarian political issue, but how does that actually affect the market from an economy perspective or specific industries? So kind of parsing through that in a little bit more detail, I think helps put greater context around, what's to come or what to look out for or different opportunities in the market.
Yeah, you could change every single one of these titles to something different. Like Gaza War. I mean, again, like we're defining these timeframes by global conflict. I mean, I view it a little bit differently if I'm taking my market lens. I don't see October 10th, 2023 as Gaza War. I say pre-artificial intelligence enthusiasm.
Hmm.
Like that's how I define that moment in time. If you were to say February 24th, 2022, Russia invades Ukraine, that was pretty much the biggest issue at the time. But I'd also say, supply chain, kind of post-COVID normalization, if I want to take my mind off of the Russia thing. February 20th, 2014, Russia annexes Crimea. I didn't even remember that. Like, I had to read this to remember that. I think 2014, I'm thinking, post financial crisis, things getting back to normal and kind of right before things started to pick up in the tech sector, which was, 2015, the tech sector started to really take off. U.S. invades Iraq. Of course, we all remember that. But March 20th of 2003. If you're a financial markets historian, you call that the end of the tech bubble burst. Or as I like to call it, a generational buying opportunity. Um, U.S. invades Afghanistan. Again, yeah, big deal. But that was like the tech bubble was kind of still matriculating out. Um, so all these things, when you kind of look at them, you can take a different point of view depending on which lens you're looking at. But if you say global conflict, I mean, yeah, these are the global conflicts of the last,
Well,
however long.
Jordan, I think that's why this is a great chart for this webinar and kind of exactly what we're trying to do, right? Where if you're sitting at home and the news can be loud and sound overwhelming, most of us aren't chief investment officers of great financial planning firms. So it's good to be able to get a little bit of your insight and kind of understand what's really going on behind the scenes when headlines are just screaming with, wartime, in this example.
Yeah, it's tough. It's exciting times.
Yep. And then, Luch, I know you wanted to take this last slide and drive us home.
The high note.
Sure, I'll kick it off for you. So we're looking at the change in earning estimates in Q4, kind of by sector with this chart. So as we had mentioned before, it's just interesting and worth talking about that. While the tech sector is down about 4.5% year to date, earnings estimates are actually up, and they had the most positive revision of all the industry sectors. And contrary to that, while the energy sector is up about 26%, year to date, the earnings estimates are down and had the most negative revision of all the industry sectors. So to the point that Brandon had made before, this is where it's really important for investors kind of navigating these markets to consider fundamentals of companies, like he had mentioned with Microsoft and so on.
Yeah, yeah. Like if you look at Microsoft, if you look at their 3 year revenue growth of 12.8%, or their gross margins of around like 60%, and then you compare that to some of the other companies in different sectors and things like that, it makes it more understandable of why these earning estimates have gone up and kind of creating opportunities of, yes, it's down this year, but is Microsoft a bad company all of a sudden because it's down 15% this year? So kind of parsing it through that and have an understanding of, you know, almost why is it down, and then also has anything changed, within Microsoft as a company? Have they made some large scale business change and that's why it's down? Is it, some other factor, from an industry perspective? Or is it kind of just the sentiment at the moment? And if you kind of look at that long term, would you still like to own Microsoft? And in this case, and sometimes the answer is going to be yes, or sometimes it could be no. But just recognizing, is there an opportunity there, even though it is down this year?
But we also expect the performance to follow the fundamentals ultimately, right?
Yeah,
It's expected that the thing with the highest earnings growth is the thing that's going to perform best, generally speaking, all else being held equal. And so when we see performance going in the other way of EPS changes, and by the way, this chart is from before the attack on Iran, but even before that attack, this chart would have been informative and kind of saying like, all right, well, some of this stuff is going down even though their fundamentals are going up, and some of the stuff where the fundamentals are going down, the stocks are going up. Help me understand that. And sometimes it will be a valuation issue, and that happens from time to time. But we would generally expect these two things. If the fundamentals are moving in a good direction, we expect the price action to also move in that direction. So we definitely see that there might be some opportunity here. The technology sector, which has been doing great and for many, many years. And there is some question here on, wait a second, well, the fundamentals are still doing well. Why is the sector starting to be under some pressure? That's something to keep an eye on, and that's something we're very careful about, is looking at the longer term trend, looking at trends through multiple time frames. to try to understand, is this just a little bit of a blip? Is this, are we looking at things a little bit too closely, or is the longer term story, impacted? At the same time, the energy sector, which is, running a little high right now because when you have conflict in the Middle East, people just kind of automatically, like Pavlov's dog, go and buy energy stocks. And at some point, if the fundamentals don't catch up with that price action, those energy stocks are going to look a lot like my 4-year-old after 10 o'clock, about to crash. So, we always need to be a little bit thoughtful. If the fundamentals don't catch up and we don't see things, happening congruently between fundamentals and price action, we got to ask ourselves what's happening and does that create a certain risk in one or other parts of the market? And unfortunately, I wish it was simpler, but it tends to be a little bit complicated. So if people have questions about that, obviously, right now, if you see oil prices going up, but then, we don't see the earnings come through, it can lead to a natural, well, should I have exposure there? Should I not? These are the kind of questions that we're happy to address and talk about because it can be complicated. Now, what else we got? Is that
That's the last slide.
all right?
Today too.
Does anyone have any questions out there or I don't know, how can we be helpful? I know this is a time when uh you know there's a lot of potential questions. Obviously, if you guys want to email us or give us a shout to just talk through what the impact might be. But I think our general if you had to take away one thing, try to separate politics and humanitarian feelings from what's going to happen with the market. Those two are different animals, and they are hard to sometimes split. It takes, a lot of training to kind of teach yourself to think about those things in two different paradigms. And so, just try to be careful as you approach markets and not getting caught up in some of the emotional aspect of it. And the other thing I would say is, don't, it is very easy to go down a negative loop when we have conflict like this and you're seeing the imagery on news channels. It kind of takes us all to a very bad place. It is horrible to hear some of the stories that are coming out of this conflict. And it can just kind of give you a sense of hopelessness and just kind of really drain uh, the positivity or optimism that we might find easier to dig up out of us on a regular basis. And so trying to, I say this, I said this at lunch yesterday. Um, Try to spend as much time thinking about what can go wrong. I'm sorry. Let me try again. Spend as much time thinking about what can go right as you do thinking about what can go wrong. And if you do that, you'll find yourself in a more balanced place. And I think you'll find yourself making less emotional decisions. And so, even as we look at this, there is some optimism around a new alliance in the Middle East of countries other than Iran. Iran has attacked kind of everyone. And those people are now, in the UAE and some of the other surrounding countries, Saudi Arabia, they probably want to play a little bit more with the Western cultures because of this. It ultimately kind of binds them to a little bit more of the peace and prosperity parts of the world as opposed to Iran, which has always been a little bit the disruption, chaos creators, along with Russia. And that can be ultimately very good and can actually lead to a more peaceful existence going forward. So there's some good ways to kind of pick these things apart. And again, just try to spend a little bit of time in that space as well. And don't get too caught up in watching the news for too long. Is that a good
You know, I just want to say if you're interested in seeing some of these charts or want to read about some of this stuff in more detail, we just had our monthly commentary go out on the website, grwealthplan.com, under Market Insights, which we put out every month. So feel free to take a look there and always reach out to the team.
well done, guys? Everyone, I hope everyone's enjoying in the New York area some of the spring weather that we're getting now. I know it's going to get cold again, but again, try to spend as much time thinking about the weather being nice as you do about the weather, getting cold again. And hopefully on to sunnier and better days ahead. See everyone soon.